It's been a month of volatility for markets. So what are those markets telling us about risk? We've assembled a panel of experts at Standard & Poor's to get their thoughts. Joining me is J.R. Reiger. We've got Sam Stovall, Diane Vaza, and Beth Ann Bovino. Great to see all of you here.
Great to be here.
Let's start on the fixed income side. And J.R. and Diane, I'll pull in J.R. first. What are we seeing? What are the signals that we're getting in the fixed income market right now?
Credit spreads have popped up, and that's a signal that near term, the markets are expecting more pain ahead.
And when we say pain, Diane, would that mean defaults?
Right. So what that means right now is the distressed market is about 30% right now, driven by commodities, and so 8 to 9 months down the road, an increase in defaults.
Sam, we've certainly seen commodities play out on Wall Street, oil in particular. What are stocks signaling to us? Because everyone has been worried that we're going to potentially move into a bear market.
Well, in fact, the investors are worried about the potential of recession. So recession, in a sense, is the disease, and so they're looking at the symptoms of an earnings recession, oil prices that have declined more than 50%, looking at the Fed starting to raise interest rates, combined with the uncertainty as to what's happening in China.
Beth Ann, could the Fed really be causing a recession?
I think the Fed wants to take their time. Virtually nobody expected the Fed to move in January, and I think that the Fed's going to basically look at the data as they say and determine what to do next. We think the Fed's going to move in March and basically take their time going forward further.
Why did the market suddenly become obsessed with these increased risks? It seems that just in the last couple of weeks we've seen a real uneasiness, although I would argue in the fixed income market perhaps there were signs even the end of last year.
Yeah, and the fixed income markets, for the last 3 years there's been an insatiable reach for yield, and with that comes risk. And 2015, the end of 2015 was realized risk. We had risk in the energy, individual bonds, and in the sector itself and materials, and that was really painful for fixed income investors. You're talking about 9% of volatility in those prices. That's significant volatility for fixed income.
And could this mean, in fact, when we look at what's happening in the energy and commodity sector, that all the risks are priced in, or no? Is default risk priced in already?
Well, we're starting to see defaults tick up. It's about 2.8% now. We have a baseline of 3.3 by the beginning of fourth quarter this year, and with a downside right now of 4.8. So that's about the long-term average. And clearly, metals and mining and oil and gas are big drivers of that.
Beth Ann, are they drivers enough to really derail an economic recovery? Can we have one sector of the economy struggle and the rest of the economy move forward?
Oh, certainly. We can certainly have one sector. We've seen it many times before.
Financial sector,
yeah,
for
exactly.
instance.
I think that the two elephants on the table, I guess you could say, for the economic recovery is oil and the dollar. Oil is certainly a drag, certainly in the Midwest, down from North Dakota all the way down to Texas, and you can see recessions in some of those regions. But overall, net on net, the U.S. is a net importer of oil, so it's a positive for the U.S. economy overall. Dollar is another factor that's actually weighing on the U.S. economy a bit more of a concern. But even there, when you take into account the overall U.S. economy, 85 to 90% of the U.S. economy is driven by domestic, not international. So while it hurts, not as much as you'd think.
Sam, we've seen the strong dollar weigh on a lot of the multinationals in terms of their earnings not being up to snuff on the revenue side. We saw that this week, in fact. But why isn't the stock market seeing positives in the economy?
Well, I think that the stock market is trying to figure out whether the U.S. could be dragged down by the other economies around the globe. The analogy being that the U.S. is the lead climber in this economic environment. All other economies are tethered to us, and if they should not have similar strong grips and good footings and fall off the cliff, that they'll simply drag us down with them. So I think that the worry is the unknown. It's the uncertainty that is really sort of working up investors.
But we've had this worry for a while, whether it's Europe or China. Why has it been exacerbated?
Well, I don't necessarily say it's been exacerbated, because we had this worry back in 2010. The S&P fell 16%. We had a similar worry in 2011. The S&P fell 19.4%. This time around, we're only down 12.7%. I think that investors thought we were supposed to get back from this correction that had earlier bottomed on August 25th. We didn't. We then set an even lower low, and that's why investors are again worried that maybe we have even more pain ahead of us.
Do we?
I think that's certainly a possibility. This expansion in prices, we went 47 months without a decline of 10% or more. The average since World War II was 18 months. And anytime we went beyond 30 months, the average decline ended up being closer to 19%.
Where's the pain to come on the fixed income side?
Mostly on the high yield side. So, and the markets have anticipated that with the credit spreads, pretty much jumping out and getting wider. But there could be more pain ahead. And when you look at credit default swap spreads, that's the cost of buying default protection, skyrocketing over the last 6 weeks. So it tells me there definitely is more pain ahead.
Diane, would you agree with that?
I do agree with that. In terms of sectors, again, anything commodity related with commodity prices at multi-year lows. In terms of regions, continued weakness in EMEA, specifically, Russia, South Africa, and LATAM, so Argentina and Brazil in terms of regions.
And is that going to be enough? You mentioned, Beth Ann, that most of what we see in the U.S. is domestic driven. So where's the worry on the economy for the Fed? What's the biggest worry for them for the rest of this year beyond the meeting of the moment? Is it maintaining that job growth? Is it what's happening with inflation, which is hard for people to wrap their heads around because they see these falling commodity prices, but inflation is more than that, of course.
Sure. The Fed, the two mandates that they have is one is jobs, or basically maximizing employment. The other one would be stable prices. So, looking at jobs, you got a 200,000 plus job gains for the last year on average. I think they can say, check, we're okay there. And even wages are picking up now. So that suggests that inflation is also going to pick up down the road. But they still are, when you look at inflation, it's still rather low. It's well below their mandate, probably about 1.3% year over year, well below where they'd like it to see. And the worry they have now is, if you're talking about worries from abroad, what they're worried about is importing some of that deflation that you might see in Europe into the U.S. That's their concern and why they might want to wait a little longer.
From the investor perspective, we'll go down the table. Every investor's like, what do I do? It's a little scary when you watch volatility, even though it's normal. So let's go down the table. Best advice for investors, JR.
Well, we don't give advice, but we can look at the markets and say what the markets are doing. The markets are migrating to the higher quality fixed income for principal protection and predictable income. And that would be the investment grade segments of the corporate bond markets.
Sam.
And I think from an equity perspective, similarly, investors are gravitating toward the higher quality issues in general, dividend aristocrats in particular.
Diane.
Again, as JR said, we're seeing folks go up in credit quality, so investment grade corporates.
And for consumers, how do they keep their cool, Beth Ann?
Well, I think turn off the debates. Don't listen to the elections. They're really depressing. That would be one thing. I think watching what's happening in terms of what they see in the supermarkets. What happens to what they can spend with their wages. Wages are picking up. I think that was something that they'd like to focus on.
Well, I want to thank all of my experts from S&P for giving us some thoughts on where these markets are going and what we should be worried about. Thanks so much.
Thank you.
Thank you, Rhonda.
Thank you.
I'm Rhonda Schaffler for The Street.